Good morning, class. Let us begin this session of strategic financial management. Last week we had studied regarding what do we mean by financial management, what are its nature, and what are its scope, and some of the terms that we are using in financial management and how do they have an effect on an organization and why is it important to understand all those terminology. In this session, let us move forward and understand some other important aspects of financial management. Definitions, characteristics, all these things we had discussed in the last uh, sessions. Even the scope of finance we had finished. So now all these things is just like memorization for you all to remember what we had discussed earlier. Okay, now speaking about scope and approach of financial management. Now, uh, be it the nature of financial management or be it the scope of financial management, it has evolved over a period of time. That is to tell, uh, financial management as a different discipline started during the 1950s, and from that point onwards until date different things has been emerged in the scope of financial management. How or what work the financial manager used to do earlier has been increased compared to now. Now they are much more involved in decision making rather than just the clerical work of finance. And in recent times, financial management as a discipline has seen a large number of developments on one hand and also innovations on the other hand from the side of be it academicians, be it researchers, or be it those who are practicing it, or also those who are regulating it. Now, traditionally, financial management, as we discussed earlier, was a part of economics. Okay, and when we speak about this traditional approach of financial management, it was mainly concerned with record keeping, arranging of funds, managing cash, and when we speak of these different kinds of activities, we can also understand that earlier or in the traditional approach, the nature of financial management was episodic in nature. And the second thing we can understand that earlier it was viewed from outsiders' point of view. That is to tell, financial management was considered from the point of view of those who used to supply funds to the organization. And also, the traditional approach or the traditional view of financial management was focused on long term finance, and there was no importance given for the short term finance, or what we tend to call as working capital. And also, we should know that earlier, or the traditional view was descriptive in nature rather than being a analytical one. That is to tell, earlier the financial management was based on the experience and the subjective decisions of each financial manager. That is called as descriptive in nature. Now, however, of around 1960s, there was an increase in competition when it came to world market or world economy. The competition started increasing. There was a rapid growth in globalization, and when there was a rapid globalization, the growth and complexities in business activities started to increase, and all this resulted in financial management to widen its scope. Now, it was not only episodic activity, but financial management also became regular in nature, and also not only in the decision making aspect. Now financial management has also increased or widened to the areas of production and marketing, and thereby it resulted in financial management emerging as a separate discipline. Now, focus was no more just on the long term financing and record keeping, but also now the scope of financial management was appraisal of finance, and also comparative evaluation of long term investment proposals, or management of funds required for running day-to-day business operation. And along with this globalization, along with this market widening, what happened was sole proprietorship and partnership gave way to corporations as preferred form of business. And when this corporation started to increasing, it may be it dividend policy or corporate governance rose in prominence. So all this resulted in the nature of finance management being widened. Now it was no more just the theoretical or conceptual basis. Now, in the present scenario, financial management is both empirical based and also analytical one. And it goes without telling that today almost every business decision uh, definitely would involve some financial implication, and therefore this financial management is required to evaluate and understood in the very best way. And one more thing we should remember is that no matter which activity of the organization, be it purchase, production, marketing, operation, or for that matter, even the logistic and human resource, all the areas of management or the decision that has to be taken under this will be mainly based on how much finance our organization have, or how much financial payoffs are involved in this. And that's when the scope, or that's how all the different activities of the organization come within the scope of financial management. Okay, now this is all about scope and approaches of financial management. Scope tells what are the different areas in which financial management is present, or in other words, what are the areas which is being covered by financial management. Now, approaches to financial management tells how financial management was being viewed earlier, and how is it being viewed now, or how is it working in the current or present time. Moving forward, let us look or concentrate towards how has there been evolution in financial management. Now, this evolution of financial management can be divided into three different phases. The first one is the traditional phase. The second one is the transitional phase, or in simple words, we can view it as a changing phase from traditional phase towards the modern phase. And thereby it is clear that the third phase is nothing but the modern phase. And one thing we should remember is, under evolution of financial management, is that now we can view it as three different phases, but the time frame for these different phases is not exact. We can only view it from the point of view of telling that earlier it was like this, and in between for some years it started to evolve, and now it has been completely evolved. Though we mentioned some dates, those dates are on the basis of averages, not exact. So, moving forward, the first one is the traditional phase. Now, this traditional phase lasted up till 4 decades. From its beginning as a different discipline, the traditional phase of financial management lasted for about 4 decades, till early 1940s. Now, in this particular phase of financial management, the focus was mostly on events of episodic nature, or as we discussed earlier, episodic finance or episodic activity. Now, episodic activities are like maybe procurement of need, capital for the organization, might be coming up with a new deal with major lenders of finance like banks, or maybe issuing of securities, debt servicing, might be expansion of the business organization or merger, and also compliance with legal aspects. Now, these things are episodic in nature because not all these activities happen in the day to day working of the business. All that we discussed now happens once in a while. And the traditional phase, the approach was mainly descriptive in nature, and also this financial management was viewed mainly from the viewpoint of the investment bankers, lenders, and outsiders, or in simple words, it was viewed from the point of view of those who used to lend money to the organization. Moving forward, the second one was the transnational phase or transitional phase. Okay, the transitional phase began around the early 1940s and it continued till early 1950s. Now, under this transitional phase, the financial management had almost similar nature and also the scope during the phase as it was during the traditional phase. So when we compare the nature or scope, there is no any difference between the traditional and transitional phase. But there was an increasing emphasis in the transitional phase given towards the planning, procuring, managing, and controlling of funds, especially to meet day to day financial needs of business. So, this transitional phase was the beginning where financial issues were being to analyzed in an analytical way. So during this time period of early 1940s and 50s, the scope and the nature remained the same as traditional phase of financial management. But the work or the activities that was being undertaken under financial management started to increase slowly. Now it was not only procuring of funds and allocating of funds, it was planning, then procuring, managing, and also controlling of funds. Now the descriptive nature was slowly being removed and the analytical nature of business started to begin. And the last one or the contemporary one is the modern phase. Now, this modern phase started in the mid 1950s. Now, this modern phase was the result of increasing competition on one side and growth opportunities, globalization, or breakthrough in economic theories and development on the other hand. Now all this led to development of more analytical and empirical approach to decision making. Now maybe it analytical or empirical simply tells that behind every decision that we have taken there is a reason why we have taken, and those reasons should be especially in the nature of explaining. It is not based on subjectivity or experience, but based on some reason, based on some principle, or based on some theory. And also in this modern phase, what happened was management or insiders' viewpoint became central to financial management. And also there were a development of many of the theories of financial management. To name some of them, theory of portfolio management was developed by Harry Markowitz in 1950. Theory of leverage and valuation of a firm were developed by Modigliani and Miller in 1958, and option valuation model was developed by Black and Scholes in 1970s. Now these three are considered as important milestones in the evolutionary journey of modern financial management. And since then, we can see that the fields of capital budgeting or capital structure or efficient marketing hypothesis or option pricing theory or the agency theory or even to name the financial derivatives, risk management, valuation model, dividend policy, working capital management, or even the financial modeling, financial engineering, international finance, and behavioral finance. Now, whatever has been mentioned, all this started gaining prominence. Now, whatever has been mentioned is just some among the hundred of theories that are being developed under financial management. Now, whatever has been mentioned, you would be studying in different subjects of financial management. It could be under strategic financial management, it can be under your SAPM, that is to tell strategic analysis and portfolio management. So, along the way, you would study all those things. And one more thing that we have to mention is that this modern phase is continuously evolving and is continuously developing. Even today, there are being innovations under the modern phase. They are still studying, and so we can tell that in coming days there would be further addition of dimensions to financial management. So let us now move forward towards nature of financial management. Now, as we discussed earlier, financial management is a long-term decision making process which definitely involves a lot of planning, allocation of funds, and also it should include discipline. So let us try to understand the nature of financial management with respect to or with reference to what kind of discipline are to be maintained under the financial management. Now, the first one is the primary nature or most important nature of financial management is that it focuses towards the valuation of company. Now, this is the reason where all the financial decisions are directly linked with optimizing, or in other words, we can tell that maximizing the value of the company. Now, we should always remember that the value of the company and the profit of the company is not one and the same. Profit of the company is nothing but what you earn by either selling or by rendering services. It is just a part of the company. When we tend to tell value of the company, it includes the entire value of the organization, not only production of goods or services, but also all the assets, be it tangible, intangible, be it goodwill, human resource, or value addition. Everything includes make the value of the company. Now, financial functions like investment, distribution of profit earnings, rising of capital, all these are also a part of financial management activities. Now, moving forward, this nature of financial management basically involves decision where risk and return are linked with the investment that is being made. Now, as we discussed earlier, investment, like in the normal way we use, it is not just investment on securities. Under financial management, when we speak about investing on something, it could be something within the organization, like investing on machinery, investing on human resource, investing on a new product, or also the normal one we speak about investing in other companies' assets also. So the one of the nature is that this financial management is involved in every decision where risk and return are linked with investment. And generally, it is presumed that high risk investment yield high returns on investment. So, thereby the role of financial manager becomes important from the point of view that he has to effectively calculate the level of risk the company is involved and should on basis of that should take appropriate decision which can satisfy the shareholders and also the investors, and never to forget the founders of the company. Now, the third nature is that this finance is foundation of economic activity. Now, the person who manages finance is called as financial manager. Now, the main or the important role of financial manager is to control finance and implement the plans. Now, for any company, be it any kind of company, be it producing any kind of product or for that matter service also, financial manager of every company plays a crucial role in it, or to tell plays a very important role in it. Many times it happens that if at all the financial manager lacks skill, or if at all he takes any wrong decision, it can lead to heavy losses to an organization and thereby lead to liquidation of company. Now it goes without telling that financial management is an important function in every company's management. Financial factors are considered in all the decisions of the company and in all the departments of the organization, and thereby it affects, be it success of the company, growth of the company, and for that matters sometimes the volatility of a company. And this is the point why we call finance as the lifeline of business. And because of all these things, we can see that financial management has become one of the important discipline that is being studied. Now this is being realized on worldwide. Nowadays people are undergoing through various specialization course of financial management. For example, all of you as individuals, you too also have understood how much important financial management is having role when it comes to business, and that is the main reason why you have also selected to study this particular subject. And when people continuously are involved in evolving a kind of discipline, understand it, further develop it, it has resulted in financial management as a subject being professional in nature. Now, one more thing we should remember is the nature of financial management is never ever a separate entity. Even though a manager could be a operational manager, or for that matter he could be a functional manager, but even those people have to take a responsibility of financial management. That is to tell, I as a financial manager, I allot money to different departments, but when the money is being given to either production or operation department, once after it is being allocated, from that point it becomes the responsibility of functional manager or operational manager to look towards the fund that he has got. So not only the financial manager, but every manager that is being working under our organization is responsible for this particular aspect of finance. And as we discussed earlier, one of the nature of financial management is that it is multidisciplinary in nature. That is to tell, it depends on various other subjects. As we discussed earlier, the first one is economics. It is where it is being evolved from or separated from. Not only that, it is also involved in subjects like accounting, banking, inflation, etc. Now, it derives many things from different disciplines with the main intention that it will use the finance in a better way. And the most important thing that we have to remember that the approaches of financial management is not just limited to business factors, but financial management or managing of finance is one of the important function which acts as the backbone of commerce, be it the economy of the country, be it the industry. Now, there is something interesting. The way how we have different P's in management, here they have tried to mention the different A's of the management. Herein they have given six different A's. That is to tell how the nature or scope or the function of the management is. The first one is anticipating financial needs. So the first function, the first nature of financial management is it anticipates, or it thinks and thereby decides how much funds are necessary for you know seamlessly do the business. Now, it anticipates the different needs by going back towards the array of documents it has. Maybe it takes the help of cash budget, income statements, or the performance documents, for that matter even balance sheets, sales, or any other income, or the cost of the organization, the tax, or the sources of funds, or the statement of you know uses of how the funds are being managed. Now every organization maintains this. Okay, so going back to that, we can definitely anticipate in a better way what are the needs of an organization. The next one is, once you have anticipated, once you know how much is necessary, the next thing that you do is you bring in what is necessary for your organization. That is being called as acquiring of financial resource. The things that you try to do is, when is this part of finance necessary for organization. Now once I get it, where am I going to invest it? Since you know when and where, you will start thinking how to acquire this. Okay, and also a financial management manager should always keep that one thing in mind, that all these financial resources that are necessary should be anticipated or acquired well before the organization feels the needs of it. And when you acquire fund, you should also remember the terms and conditions. How would it differ from time to time? Now, acquiring financial resource mainly depends on the strength and size of the company. The better your company is positioned, the more easy it is to bring in funds for an organization. And one more thing that makes this easy is the financial image of the company. This plays a very, very important role in deciding whether the company is going to get the financial resources easily, or will it have to face any kind of difficulties. Now that you have got the money that is necessary, you start allocating the funds in the business. Now, as I said earlier, it is not only outside investing, but investing them in the best plans of assets. Now, when you allocate the funds, it should be balanced by weighing two different things. That is, the profitability of the funds should be balanced against the liquidity. That is to tell, whichever thing or on whatever asset you invest, there should not be any kind of overfinance, there should not be any kind of underfinance, but a balance should be maintained. Now, the balance to the exact point can never be made, that is always there. But when we speak of balance, we tend to tell it is that point of, or it is that particular point in the organization where the benefit is maximum and the disadvantage is minimum. And when we allocate funds, we should always adopt what we call as marginal principle. Now, principle speaks that even the single or the last rupee that has been invested in each kind of assets brings in some kind of benefit for the organization, or even the last rupee that we invest should have the same usefulness for the organization when compared to other assets. Okay. Now, being a financial manager, his primary responsibility might be, maximizing the value of the company. But as a financial manager, he has always see to that there is continuity in the flow of business. Now, once you have allocated funds, the next one is administration of the funds. Now, it is nothing but, as we speak in earlier, we should watch how each rupee that has been invested is performing. We'll also have to watch how the funds of finance are being made or how the flow of fund is being managed. Now, this is mainly done when, when there is increase in the efficiency, it reduces the cost of operation and also earns fair amount of profits to the organization. That is how the administration of funds is being made. The next thing that is being done is analyzing the performance of finance. Now, administration is different, analysis is different. Now, administration helps in taking the decisions in a better way. It could be through budgeting, he would be able to compare the actuals with the standards. Now, when you do an analysis of return on investment, it should be continuous or constant or always higher. Now, the cost and return of investment of each financial decisions should be analyzed. Now, wherever the organization finds any kind of deviation, it is necessary that some of the steps are being taken to adopt and to overcome such deviations. And that is when it helps in having a fair amount of liquidity in the organization. And the last one is accounting and reporting to the management. Now, this particular A of financial management was definitely being there since its inspection or from the traditional phase also. Now, yes, I as a financial manager, I'm definitely going to take some of the decision, but even I am responsible to report it to the top management or to those who are concerned with. And one thing that we always have to remember is that whenever a business fails, the business failure may not be always because of financial, failures, but financial failures definitely leads a business to fail. That's why finance becomes important and is called as lifeline of business. So I guess we shall wrap it here for this session and come back at 12 o'clock for our next session. Wait until I take your attendance, then you can leave the meeting. Yes, class, you can leave the meeting for this session and come back at 12 o'clock.